Hi everyone, a very good evening and once again a very warm welcome to our Edelweiss Connect classroom session. First of all, before I start, I would like to first genuinely thank you all for your patronage and you joining us on this every 2 month session that we've been doing, and we hope that we've been adding value and giving you a better insight in terms of how you could take better investment decisions. Starting April, what we aim to do is move this from a bi-monthly to a monthly thing, and we'll be doing far more programs with you, and sharing even different and more interesting insights to help you take better informed investment decisions. Today's topic that we have chosen is simplifying fixed income investing. Right. And usually when we talk of fixed income, and the fact that is there is when it comes to traditional fixed income, we all have been investing in these traditional products, right? And primarily the reason why I think most of us still prefer the traditional fixed income product basket is because there is a little bit of certainty in terms of how much returns will I get. There is a certain level of safety and comfort that has been built over years, and that predominantly is the reason why a lot of us have still been shying away from the fixed income basket of investments, which probably mutual fund companies are also offering. To be very honest, it is probably a little unfortunate because even if you look at AMFI data in the fixed income basket, the pure fixed income basket products, just about 4 to 5% of investors are retail investors. So clearly, when you look at this data and when we look at all of us also here, it could probably boil down to because we probably do not really understand the fixed income options being offered by mutual funds with the kind of clarity and comfort which I am used to in this category. So I'm going to try and help you, build that clarity. And during the course of this session, give you certain ideas of how the mutual fund basket of products offered by, or the fixed income basket of products offered by mutual funds can also be used as a very smart investment option. Okay, so that's going to be my primary motive, and this is going to be our agenda. We'll talk about what are the various categories of products. We'll talk about in terms of risk, how do the products stack up. We'll talk about, some key concepts in terms of understanding fixed income investing, and we'll look at how can you use these key concepts in your investments when it comes to either active or passive fixed income schemes. As usual, you can put your questions in the chat box, and I would respond to each and every one of them towards the end of our session. So on that note, let's begin our session and let's start with this categorization. Okay? And as you can see in this chart, it's a very busy chart, right? There's a lot of data. There are 16 categories in which fixed income investing is happening under the SEBI categorization. Okay, there are investments in which you can invest, in which mutual funds invest in maturities only up to a day. Then there are investments in which maturity is only up to 91 days is allowed, then up to about 3 to 6 months, and then there is 6 months to 1 year, then beyond 1 year, between 1 to 3 years, 3 to 5 years, So there are various categories of investing which are available. So there are 16 categories, and there are corporate bonds, there are credit risk funds, there are GSEC funds. And clearly what this is telling me is there are a number of options available. So depending on what is the maturity that I am comfortable with, depending on what is the portfolio quality in terms of credit risk, corporate bonds, or other debt and money market instruments which are available, I can clearly and very easily select the investment which fits into my understanding and comfort. So there are a number of categories, and that's available for all of us to choose. In terms of understanding with regards to the risk that your investment would be taking when you invest in fixed income, traditionally, if you look at it, this is how the risk versus, the potential risk versus the potential reward, kind of stacks up. So at the bottom is the overnight funds. Then you have liquid, then you have money market, then you have ultra short, then you have short, then you have medium term, long term, then you have GSECs, and that's how this entire thing stacks up. Now, the way this actually works, to be very honest, is, when you look at fixed income instruments and the risk, the probable risk that, your investment into fixed income may get exposed to, then it is said that, the shorter the maturity, the lower the risk. Okay, so when we talk of equity, we normally tell it's the other way around, right? I mean, when you stay invested for the longer period in the equity markets, and there is data which you may have seen or you may have heard about, that when you stay longer, the volatility kind of becomes lesser, and the probability of positivity goes higher. On the fixed income side, the shorter durations are usually less volatile. Okay, I mean, if I were to give you an example of how this actually plays out, I mean, imagine, a friend of yours comes and asks you for some money, a friend, a relative, or somebody whom you know, and he or she tells you, I mean, for his or her work, okay, and he or she tells you that I want money for a 2-month period. Let's say whatever the business may be, and you may ask, why do you need money? How will you repay my money? And there will be a very, very bound answer that this person may give you, because the period is only about a couple of months. So he or she knows from where the cash flow is going to get generated, through which he or she will be able to repay the loan that he has taken from you. Right. So that's for about 2 months. I mean, similarly, when you expand this to, let's say, a 1-year period, the same person may be able to tell you how the cash flow is going to come. And, in a 1-year period basis, past analysis, how his or her company has grown. And hence, repaying the loan may not be a very stressful thing. That's the story that anyone who's borrowing will probably come out with. I mean, when this 1 year becomes a 3-year period, again, there is a strategy that is in place of how in 3 years the company will grow and how the repayment will happen. When you talk of 5 years, you talk of vision. This is where my vision for the next 5 years is, and this is how my company will grow. The point is, and when you expand it further, I mean, again, it becomes from a vision, it could move into a dream, that's how it's going to go. The point is, when the period or the maturity period, gets expanded, there could be a lot of probabilities which could come into play, which may work against your plan, your strategy, your execution, your vision. Right. It could be a situation where there is a change in regulation, because of which, my product is now not doing as well as it was doing earlier, because of which now I have to re-strategize, and that's going to take time, or, the business is not going to work as well. Or it could be that my competition is doing better or has come up with better product, better pricing, because of which I am getting stressed. So the probability in which things can go wrong or could go wrong kind of increase when the period of loan increases, right? But when the period is small, so let's say I come and ask you for money for a week or 10 days or 2 months, that probability kind of shrinks. And because that probability is shrinking, the probability of me returning your money with my committed interest goes up. And that is why it is said that when you're looking at shorter maturities, the risk over there, the probable risk over there, reduces in that sense for any investor in comparative to a longer maturity loan. So that's with about risks and rewards. Now, when you talk of some key concepts, and when you, sorry, before we move to key concepts, when we talk of risks per se, there are a number of risks which could be into play when you're investing, even in fixed income. So the first risk is that I want to talk to you about is the interest rate risk. Now, interest rate cycles, so for example, in the last 1 odd year, we've seen an interest rate rising scenario. And it is said that when interest rates are rising, bond prices fall. I mean, there's an illustration, in the next few slides, which I'll show you, how that impacts your investments in a particular, could impact your investments in a particular portfolio. So we'll talk about that in a little more detail, towards the end, in some time. But what it means is, in a fixed income investment, it becomes very, very important for me to have an interest rate views, especially on the longer maturities. On the shorter maturities, the impact may be that much lesser, but on longer maturities, it may have a material mark-to-market impact. And because of that mark-to-market impact, my probable realized gains, cannot, or rather unrealized gains or losses will look not that great because of this interest rate risk. And hence, understanding this becomes a very, very important part when I'm investing in fixed income. The bigger risk, or the biggest risk for any fixed income instrument investment, is the risk of default, which is our nest risk, right? Whenever I'm giving money to anybody, whether it is somebody who I know or an organization, the primary thought which bothers most of us is how safe will my money be. That is why there are rating agencies giving a rating to organizations, and and there are various mechanisms in which the market is trying to ascertain the probable risk of default, because when there is a default, your entire capital which is invested stands at risk, right? And hence, for most investors, that's a big chunk where people want to be very, very, very cautious about whether there is any probability of default. In fact, for most of us, if there is any iota of doubt, thought that there could be a default, you and I, nobody would want to invest in that person, in that organization. Then there is a liquidity risk. Liquidity risk is, you have invested, you have a fixed income paper, and now you want to sell it, but there are no buyers. So if there are no buyers, unfortunately, then that paper stays with you, because nobody wants to buy it at the price that you want, or maybe that paper is not as liquid. So that becomes a third risk which people will carry when they are investing in fixed income risk. Then there is a reinvestment risk. When you talk of reinvestment, I mean, for most of us, even when you look at traditional fixed income instruments, like let's say an FD, a lot of us may probably be doing a 1-year FD. And with an auto renewal, or however that works, right? And then what happens is when the year is over, there is an auto renewal, or you will go to the bank, or you will get in touch with your RM, whatever mechanism you follow, you would renew the FD at the rate which is now prevailing in the market. If the rate falls, then you get a lesser rate. If the rate goes up, then you get a higher rate. So this is obviously, when most of us may probably not understand or really follow the interest rate cycles to have a view whether the rates will go up. So I should take a shorter maturity now so that I can lock money for a longer maturity later on. What you could then do is you could probably invest for a longer period if you think this rate that is coming to you is suited to manage the returns that you think are worth when you're investing in a fixed income thing. Okay, so that's how you can manage some kind of reinvestment risk. Then there is inflation risk. Is your money making money more than the inflation? And if it is not, then technically the money is degrowing. And hence, understanding your post-tax net returns and evaluating that in comparison with inflation, whether you are investing in traditional fixed income or you're investing in fixed income products through mutual funds, is a very, very important element which we all should keep in mind, because we all will agree that when it comes to inflation, this inflation is general increase in prices. That means that my cost of living on a month-on-month, year-on-year is going up by a certain percentage, and I should be able to make more money from my investments so that I'm able to manage this inflation successfully. Apart from this, there could be an event, there could be a regulation change. So a pandemic is an event. When this event happens, are there certain risks? I mean, it could be something else. Is there a regulatory change? Is there a call risk or timing risk that when I entered, the interest rate cycle started to move up, and because of which, now I'm seeing mark-to-market losses, in my portfolio. So understanding all of these risks kind of can be a little cumbersome. And hence, if I want to do it individually, there'll be a lot of things that I would have to focus upon. How can I manage these? I mean, you should look at it in terms of, managing this through maybe investing into mutual fund portfolios, which you feel, are to your comfort. And that's how you could manage a lot of these risks. Moving on to some key concepts, and we'll talk about these 4 concepts. We'll talk about yield, we'll talk about yield to maturity, we'll talk about weighted average maturity, and we'll talk about modified duration. These 4 concepts which become very, very important when we are investing in the fixed income products through mutual funds. And this data of all, I mean, the YTM, yield to maturity, the weighted average maturity, modified duration is available for all schemes in their monthly fact sheets. So it's very readily available. You can even look at it in terms of, going to any MF website, and, when you choose a scheme, you will get this data. But understanding this data becomes extremely important to start with. And so once I understand, I'll be able to decipher this data much better. And with that, understanding, I'll be able to judge, which is that scheme which works for me, right? So let's start with yield. Yield, is, in simple words, you could call it return, yields. Okay. And it is, how much of a return am I going to make on the investment that I make, right? So yield is the effective rate of interest paid on a loan in a very, very simple nutshell. Now, when it comes to yield to maturity, okay, so when you talk of mutual funds, I mean, there is not one investment in any one paper that they are making, right? And you look at a mutual fund portfolio, you would have about 25, 30, 35 different names that would be available, sometimes even more, in any mutual fund scheme. And each paper will be giving different returns, right? And hence, you talk of something where you talk of, when I'm looking at this portfolio, what is my yield? And for you, YTM would be, what is, if you stay up to the maturity of this portfolio, what is the return or gross returns, rather, to be more precise, what is the gross returns that you would be making if you stayed up to maturity? So what is maturity? Maturity is predominantly the time in which, this portfolio, the papers that are held in this portfolio will mature, and you would have to invest the capital that you get, along with, let's say, the interest that you have, into newer papers. right? So yield to maturity is the gross returns that you stand to gain if you invest in this portfolio, and this number is published for all the schemes, all the fixed income schemes from mutual funds. So there is an idea in terms of the gross returns that you would be making when you invest in any scheme. Predominantly, some kind of an idea is what you can get. Okay, then the next thing is weighted average maturity. Like I said, maturity is when the paper will mature and the money, the principal and interest, everything comes back to you, and this paper is now no longer in circulation, right? When you talk of MFs, we also spoke about, there are a number of different schemes or different papers that a mutual fund scheme is investing into, right? So, but it is not uniform, right? So let's say if I am a scheme and I have, let's say, 100 crores as my investment amount, I will not go and invest 5 crores in 20 papers, which is unilateral. And then what will then work is I will look at an average maturity. So there will be a paper in which I may invest only 1 crore. There may be a paper in which I may invest 2 crores. And then a paper in which I may invest 7, 8, 9 crores. So basis this, what becomes more important for me is to calculate what is the weighted average maturity. So the weight of investment is where the weight comes from, and basis that I will come to an average maturity of my portfolio, telling you what is the weighted average maturity of the various papers that are being held in a particular scheme. So when we go back to the categories, I mean, there was a category for a day, for a 91 days, for a 3 to 6 month period, up to 1 year, 1 to 3 years, 3 to 5 years. Now, when you talk of, let's say, 1 to 3 years, then all the papers in that scheme will have to be in that 1 to 3 year as per that categorization. But there will be some papers who will be at, let's say, 1 year and 2 months. There will be some paper at 1 year and 6 months. There will be some paper at 2 years and 5 months, and there will be some paper at 2 years and 9 months also. Now, depending on what is the investment base and the percentage of investment, I will calculate this weighted average maturity. This is the second term which becomes very, very important for all of us to understand. And the third term is this term called modified duration. When you talk of modified duration, like I was speaking some time back, when bond prices, when interest rates go up, bond prices fall. When interest rates go down, bond prices rise. So basically, the modified duration tells me how sensitive is this portfolio to the interest rate fluctuation. Okay, usually you will have a modified duration which is lower than WAM. WAM is the weighted average maturity. Okay, so usually it will be lower. Okay, I mean, it usually is lower. So when you talk of this modified duration, this will basically tell you if there is an interest rate fluctuation in the market, how will that impact my returns during the period. It could be mark to market because I'm in the period, so I will have unrealized capital gains or capital losses depending on how that works. Or if I decide to get out of that scheme during that period, that will then impact the returns which I may also take. Okay, so that is why modified duration becomes extremely important. And like when these are those terms which we should all understand, primarily because whenever we are investing in any mutual fund schemes, whether it is an active scheme or a passive scheme, somewhere, what am I going to get in return? What is going to be my return when I invest in these fixed income schemes? The answer to that will come from these key data points which are available for all of our consumption for any and every fixed income mutual fund scheme in terms of the data which is either available in the fact sheet or on the website for each scheme. Okay, so when you talk of active schemes, let's look at these 3 data points. We have something, well, let's say there is a scheme where a weighted average maturity is 3. So what that means is in 3 years, the entire portfolio that is there will mature. Okay. Similarly, we have something where we have modified duration as 2. So what this is telling me is that the interest rate sensitivity is 2 years in this particular scheme. It's just an example. Okay. And the yield to maturity, if I stay up to maturity, maturity is 3 years. If I stay up to maturity, the gross returns that I will earn is roughly about 8%. Okay, it's gross and it's rough. So that gives you tentative idea of what is the scheme composition. So apart from this, obviously there is a portfolio, there is a where there is name, there's portfolio quality, which also become extremely important to look at. But in terms of understanding and analyzing of what is my return or what could be my return and what is the risk in terms of the interest rate fluctuation and what is the maturity that I'm looking at, these 3 other data points will become key. Okay, so like I was saying, when let's say you are looking at interest rates rising, so like in the last 1 odd year, we've seen an interest rate hike scenario. And if interest rates are rising and you think that interest rates will further rise by about 1% in the next 1 year. So what then that becomes, what that data point or analysis becomes important because then I need to evaluate of how will this impact my portfolio and the returns that I may get in the next 1 year. So quite simply, when you're looking at this, what I'm very simply doing is if I'm looking at a rise in interest rates, I quite simply will subtract the modified duration from my, so modified duration into the impact that I'm anticipating. In this example, it is 1. So 2 into 1 is equal to 2. I will subtract this from my YTM. So 8 minus 2 will become 6. So at the end of 1 year, your gross yields will move down by 2 percentage basis points, and you would make something about 6%. Okay. Similarly, let's say you think the interest rates will fall. That's another example, which that's another way in which markets work, right? And let's say you think in the next 1 year, the interest rates will fall by about a percentage. Now, what is going to be the impact of that? Quite simply, what I will do is, in this time also, I will multiply my modified duration with the impact that I anticipate, in which case, in this case, again, it is 1%. So 2 into 1 is equal to 2. But this time I will add. So when it's falling, I add. So 8 plus 2 is equal to 10. So my gross returns at the end of 1 year should move up by 2 percentage basis points. And this should become about 10%. Okay, so this in the active fund management or in active fixed income schemes, it becomes very, very important to somewhere understand interest rate fluctuations, specifically in longer maturity instruments. Because when you're looking at longer, over here, our example was weighted average maturity of 3 and modified duration of 2, but there are longer maturity instruments also, where let's say a weighted average maturity may be 5 and you may have a modified duration of 4, 4.5. So that's how the impact may further be deeper. So in that sense, when you're talking about active fixed income schemes, understanding and taking a call on interest rates becomes a very, very key ingredient for longer maturities, more specifically, because that kind of has an impact on what your returns could be. At least, I mean, you may stay up to 3 years. So this cycle may work. So there will be an MTM, M2M, mark to market gains, losses, whatever it may work. But if, let's say, the portfolio remains static, you may still get about 8%. But during the entire cycle, there would be notional gains or losses which you may see. And hence understanding of and taking a call of how the interest rate cycles are going to play out during your investment period become a very, very key component when you're talking of active fixed income. Okay. At the same time, there are passive fixed incomes, right? When you talk of passive fixed incomes, there are open-ended fixed incomes, and then there are fixed tenure or fixed maturity fixed incomes also. So in open-ended, for example, it could be something where papers where maturities are maintained and regularly rebalanced. And in a close-ended, papers are usually held till maturity. Okay. Now, when you talk of this category, then your YTM or yield to maturity, your gross yields becomes more predictable. Because over here, since papers are predominantly held, at least in the close-ended or the fixed tenure category, not close-ended, sorry, the fixed tenure category. Because over here, then what happens is, your YTM becomes your gross yield because papers are going to be held up to maturity. So over here, if I become comfortable with the portfolio quality, and that is available, right? I mean, for all schemes across fixed income as well as equity, what is the holding with along with percentage is published. So that's readily available. If I feel that this is a portfolio which, and usually when you talk of passive, they invest in government securities, they invest in public sector undertakings, they invest in state development loans. So generally portfolio qualities are very, very, safe, looking at the quality of papers that are there. So in terms of that, so when you talk of, if I don't want to understand interest rates, then passive, and looking at passives, you look at in portfolios where the quality of papers being held is something which you are comfortable with, which giving you comfort that this is a good quality portfolio that has been created. Then over there, your YTM, when you stay up to maturity, will kind of become your gross yields, So when you stay up to maturity, that is the return that you would make, gross returns that you would make, because there is no churn in portfolio. It's not active where the fund management is buying and selling on a regularly basis. It is held up to maturity, and that is why over there your YTM becomes very, very important. Okay, so this is another way. Now the third way, in which you could manage your investments is called something which is known as bond laddering. So let's say you have investments, you want to invest, but you don't know interest rate cycles, and you don't know when will you need money. So you can scatter across maturities. So let's say, as an example over here, as it's already there on the slide also, you have 10 lakh rupees. You invest 2 lakh rupees in papers maturing in 1 year, 2 lakh rupees maturing in 3 years, then 5 years, 7 years, 10 years. You spread it. Now, what happens is when you spread this, after 1 year, you get the money, 2 lakh rupees plus whatever was the YTM gross, you get that. Okay, you get your interest, or coupon as it's known in fixed income language. And what do you do? Now, if you need the money, you use it. And if you don't need the money, you go beyond your last maturity that you're holding. So in this, there was 10 years. So you will say, okay, let me go and buy a paper at a 12-year, invest in a scheme which is in a 12-year maturity basket. So you keep on laddering. So if you need the money gets available, you know whether you want to use it or no. And second, because I'm not too sure of how the interest rate cycles will play out, what this does is this allows me to average and invest into various maturities. And because various maturities will give me various and different yields or returns, my aggregate will be the average of all the returns that I'm making. So this can also be played in a very, very smart way. And this is a very, very smart strategy, which you can use when you're investing in fixed income. If you don't know, what is the maturity when you will need the money, which I think is true for most of us investing in fixed income, because we don't know, when will we need the money, but we think that, we don't want to put all our eggs in the riskier equity basket. So we also have some fixed income allocation which you do, which is absolutely correct. And if you want to explore this, you could explore it by investing into fixed income schemes by MFs. If there is a certain interest rate understanding that you have, then you can even take active calls. If you don't want to, go into active because interest rate cycles is something which you think are not very easy to predict, which is true for maybe most of us, then passive becomes a good play, because over here, the excuse me, in terms of your gross yields, they become very much more predictable, and investing in this kind of helps you a certain uh, the returns. And because there is no churn in portfolio in terms of passive investing, in a basket where you know the names and you derive comfort from those names, also becomes a very easy strategy to deploy. If I don't know when I need the money, then I can also use bond laddering, and this helps me in managing my liquidity, as well as not being too bothered in terms of the interest rate cycles, because at every time I'm only averaging it out. So whether the interest rates are going up or going down, I will still have an average which may be a better average than being caught on the wrong side. Okay, so this is what I had for all of you people, and I'll now open it for questions and respond to your questions. Okay, so there is a question for longer duration products. How do you deploy the interest on the papers at the same rate for the longer durations in the interest rate cycles may be changing? Absolutely correct. As the interest rate cycles are changing, it is something where for longer durations that risk in terms of when interest rates are going up, you may have a mark-to-market loss in your portfolio is something which is there, and hence when you're looking at longer maturities, it becomes very important that I have a certain understanding on interest rate movement, and basis that take a call in investing in maturities for longer investing in longer maturities. Otherwise, your mark to market or timing the market may be wrong, in which you may have certain losses, which may be something which may be part of your portfolio. So yes, you need to do that. You need to take interest rate calls if you're looking at longer maturities, and your most gains will come when interest rate cycles are on the decline. So your best bet to invest in longer maturities is during an interest rate decline scenario. Okay, so there is a question. Okay, so there is a question. Can you explain the difference between floating rate and dynamic bond funds? If I look at the category, let me just open this. Okay, so there is a floater fund, which is there over here. Sorry. Why is this? Okay, so a floating rate fund, a dynamic fund is something which invests across maturities, as it's mentioned over here. And when you talk of, why can I not show this? Somewhere it's getting stuck. So okay, and a floating rate fund predominantly is, I want to show this to you. Let me see if I can. Yeah, a floater fund invests minimum 65% in floating rate instruments. Okay, so floating rate instruments are instruments where your rate predominantly is a floater rate, including fixed converted to floater rates. So a dynamic bond will be something which will invest across maturities. Over here, 65% will be in a floating rate. So the rate by itself will have will have a benchmark through which it is taken care of, and that is how it is a little in terms of returns also it is a little different. Okay. Okay, so then there's a question, so there's a question where someone's saying that scheme details are not available for passive short duration funds. It is a recently launched fund. We are still probably deploying money. Once the deployment is completed, you will have those details available. Okay. Okay. So anyone else? Any other questions, queries, which you would be having? There are some more questions which are more product specific, but since this is more of an open program for everyone, I would not want to take product specific questions. I mean, if it is something in terms of concept, I'll be more than happy to take them. For those product specific questions, I will request you to get in touch with your relationship manager, or visit us separately, and we'll be more than happy to answer them one-on-one. Okay, so I think no more questions. So I hope this program is something which has helped you get more clarity in terms of understanding of how you could use the opportunities available in the fixed income investment through mutual funds, and use this the next time you are looking at deploying money in the fixed income instruments, and take benefit of the various investment options that are available in the fixed income investment universe through the mutual fund route. On that note, thank you very much, and we'll see you again in April with a new program. And I hope to see you all there joining us. And thank you very much. See you. Bye bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.